So we will see a situation, and it's not me seeing it on my own. It's the Bureau of Labour Statistics who publish the projections forward see it too. It's there in black and white. The interest component of the US budget as a percentage of what they collect in taxes is set to rise and rise and rise. We've come from about 8% of the tax in a year or two ago. 8% of the tax was being used to finance the interest. By 2027, that will be about 30% of the tax take. And by the year 2031, it will be 100% of the tax take.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I'm super excited about, and I know you are too. Today, we're fortunate to have with us Clive Thompson. Clive is a retired wealth management director. He began his career in 1975 in the UK and has had an unblemished 47-year career in trusts, wealth management, and Swiss private banking. Clive is still an active investor in all major asset classes, especially global equities. On a daily basis, he's trawling through company balance sheets, reports, and recommendations, and he gives interviews just like this one. Clive, thank you so much for joining us today.
Well, thank you very much for having me on this show, Gary. I've been retired for over 2 years now, and it keeps my brain functioning to keep looking at the markets, keep analyzing the way the economy is going, and looking at the balance sheet of the Fed and inflation numbers and labor numbers and things like that. So I'm open to answer your questions or your readers' questions or your listeners' questions.
Yeah, and I know everyone's excited to hear what you have to share. So let's dive in. Let's begin with how you see the current state of the markets and the economy.
We've been through a very extended period of rising stock markets and no recession. I've been investing money for 50 years now, and every year I've ever invested money, there have been plenty of people saying, one, a recession's just around the corner, and two, the stock market's about to collapse or go down or decline. Now, recessions, I think in those 50-odd years, I've seen I think there's been about 7 of them, so not a lot. And in terms of stock market collapses, yes, I've probably seen some big ones, perhaps about 5 or 6 really big ones and 4 or 5 small ones. But the reality is most years have been up, and most pundits have been saying that stocks are about to go down have been proven to be wrong. But sooner or later, they get to be right. And those who get their timing right the first time are called heroes. And when they make a prediction the second time around, everybody jumps on it and says, the man who predicted the housing crisis or the man who predicted the stock market crash in 1987 now says, I've never seen anyone get it right twice. And I'm certainly not going to claim that either. So I don't know the future. But what I can say is the official numbers, which are coming out of the United States, seem to show that the economy's running okay, but that's not to say there aren't millions of people who are literally on the breadline, who can't get jobs and are suffering very badly. So, one's got to try and, when one says the economy is doing okay, it's actually 2 worlds out there. Half the economy is doing okay and half's not. And then you take add the 2 together and you somehow get to some sort of global picture. So I know if I was to say here, the economy is doing okay, there's going to be lots of people jumping in your comments and saying, what's he talking about? This is disastrous. It's not true. But you can't sort of say it's doing okay I can say it's doing okay for some people. It's doing terribly for others. Where I think we're going is, I think the major things which are happening at the moment, which will affect how things play out, are all eyes are on the Fed and have been on the Fed for a very long time about when they're going to cut. And these cuts have been talked about for a couple of years now, since they got to peak interest rates at 5.25% to 5.5% about a year and a half ago, 2 years ago now. That date of the cut keeps getting pushed back. There's quite a few pundits who think a September cut is possible. I think some people are now saying it's not going to come till next year. and there are those out there who say maybe it'll never come. They're very much in the minority, but that's the direction of travel. People are shifting a little bit to say the cut is not as certain as it was 6 months ago. So that's going to be a factor which will play into the way the world economy goes. But of course, that's influenced by other things, such as the jobs numbers. If the job numbers come in very bad, and it depends which job number we look at, Mr. Powell's looking at the non-farm payrolls number, which has so far been showing very good numbers. But there's plenty of people out there who would say, well, that's rubbish. You've got to look at the household number, which is showing a complete opposite story. But that's the number he's looking at. And again, when it comes to inflation, he's looking at PC core inflation, which is it's coming down, but whether it will get at the official level to his 2% level, I don't know. But I think the direction of travel here from the Fed is one of slowly but surely adjusting that we've got to hit 2% target to one of we've got to be confident we're going to get there at some point. And I think that might be just enough for them to cut rates. It's sensitive to cut rates because we're in an election year, and obviously if and when a rate cut does come before the election, some people might say that was politically motivated. And there was a letter written about a week ago by Elizabeth Warren and a couple of other senators to Chairman Powell. The words they used were they were urging him to cut the interest rate.
Do your job, right?
It was kind of we're your bosses, do as you're told.
Right.
And they gave him some good reasons why he should do it. They said, well, look, for example, if we take out one of the things which has risen so much in price, which is shelter, that's housing costs. If you eliminate that from the inflation numbers, there isn't any inflation at all. It's only 1.8%. So you'd be within your target. Just ignore shelter, then you've done it. Which I thought, yeah.
Maybe ignore food and energy as well, right?
Well, I mean, I would say, why not just we should ignore everything which went up in price, and then the inflation's zero. But the reason for ignoring shelter is because we've got more people in America, therefore the supply of housing is going down. So availability of accommodation has gone down, number of people looking for accommodation has gone up, rents have gone up. So that's not inflation, of course. It's not inflation. It's more people. It's supply going down, demand going up. So the other thing that she was suggested in the letter to take out of the equation was motor car insurance, which had gone up 23% in the year to April. And the reason which was suggested for motor car insurance going up was there'd been more accidents. And that's why insurance costs have gone up. So again, more accidents, that's obviously not inflationary. But, I think we had the same sort of discussion a few months ago when medical costs, insurance costs had gone up.
Yeah.
And so they reduced the weighting of that that wasn't obviously down to the Federal Reserve, of course. That was the Bureau of Labor Statistics who reduced the weighting of medical insurance after the price had risen drastically. And, it does seem rather odd that you reduce the weighting of something when the price is actually going up. And I think perhaps the underlying story was was the cost of medical care had gone up, or medical insurance had gone up so much that people couldn't afford it anymore. So the number of people paying it is reducing, and therefore it should have a lower weighting in the index. It's all, I think what we get down to is two things. First of all, is Chairman Powell and the Federal Reserve Board going to be pushed around by the Senate? And from another point of view, how many people really trust the Bureau of Labor Statistics inflation numbers? Are they completely reliable?
I think you make fair points.
So that's one of the factors which I think is, we're talking about the inflation rate, the interest rate, that's all kind of interwoven. And going with that is what will happen to the dollar. I think if we do get to a point where interest rates start to get are being cut, and if the market perceives that the next cut is the first of many, that's not going to bode particularly well for the dollar, which has been very strong because quite a few central banks have cut their rates, and the ECB amongst them, Switzerland another one. The US has not. But when the US starts to cut the rates, and if people say, well, that's the first of several, I think that could take the shine off the dollar a little bit, and we might see a weakening dollar. I think there's another longer term thing at play, and that's the level of US debt. I think everybody knows that there's nothing being done to address rising US debt, the government debt. It's been rising as a percentage of GDP for many, many years. If we go back to the 1980s, debt to GDP ratio was in the around 40%, and we're now over 100% debt to GDP ratio. And according to the Bureau of Labor Statistics' own numbers, which is a department which projects things forward based on the government's official budget, that debt to GDP ratio is going to continue to rise ad infinitum as far out as the eye can see. Now, the problem with that is that as the level of debt rises, so does the interest the government's got to pay on it. And what that means is the amount of interest the government's going to be paying on it as a percentage of what they're collecting in taxes is rising. And there's two factors at play here. One, the debt is rising faster than the economy and is forecast and scheduled, projected to continue to do so. So that increases the amount of interest they have to pay compared with what they're collecting in taxes. And the second factor is that the interest rate they're having to pay on that debt is rising because most of the debt which the Treasury, where they borrowed money over the last 10, 15 years, they were borrowing for the most part when short-term rates were at 0% and longer-term rates were 1.5%, 2%. So they have an awful lot of bonds out there. The vast majority of them are at quite low rates. I think the average rate is something like 2.3% at the moment, which are going to gradually mature over the next few years. And as they mature, not only are they going to have to roll over that debt at a much higher rate, and the higher rate now is 5.4% for the short end, i.e. T-bills. And if you look at the 10-year, it's about 4.25%. So that's significantly higher than the 2.3% average they're paying now. So not only are they going to have to roll over the existing debt at double, let's call it double for simplicity, the rate of the maturing debt, they're also going to have to finance all of that new borrowing which is needed at these higher rates. So we will see a situation, and it's not me seeing it on my own. It's the Bureau of Labor Statistics who publish the projections forward see it too. It's there in black and white. The interest component of the US budget as a percentage of what they collect in taxes is set to rise and rise and rise. We've come from about 8% of the tax in a year or two ago. 8% of the tax was being used to finance the interest. By 2027, that will be about 30% of the tax take. And by the year 2031, it will be 100% of the tax take, quite possibly. That's obviously a bit of a high-in-the-sky number, but that's the direction of travel.
Yeah, so there's so many concerns. There's a lot of pieces there to talk about. Let's start with one you didn't mention. You recently wrote the end of the yen carry trade could lead to billions, if not trillions, of U.S. treasuries being dumped. Japan then came out over this past weekend and said that they are ready to intervene in currency markets 24 hours a day if needed. Will you dive into what's happening with the yen, why you believe the end of the carry trade could lead to billions to trillions of U.S. treasuries being dumped, and what do you see as the coming consequences of this?
So I'm referring specifically to the hedged carry trade. This is where a Japanese bank, but it could be a hedge fund or it could be a Japanese housewife, but let's take a Japanese bank because they would be the key players in this, will have in the past, over the last decade, found it profitable to buy US treasuries and hedge the currency risk back to Japanese yen. And what they will have done when they did the hedging, the way hedging works, currency hedging, it's the cost of currency hedging is effectively the difference between the two short-term interest rates. So if we go back 3 or 4 or 5 years when interest rates were as good as zero in America, let's call it for simplicity 0.1%, and in Japan they were minus 0.1%. The cost of hedging back to Japanese yen was the 0.1 in America plus the minus 0.1 in Japan makes 0.2. That was the cost of hedging to a Japanese investor. So what the Japanese investor could do, he could buy an American government bond yielding, let's say for simplicity, 2%, hedge that currency risk back to yen at a cost of 0.2, giving him a net yield of 1.8%, which was significantly higher than he could have got on a Japanese 10-year bond yielding at the time approximately 0%. So it made sense. And for many, many years, most of the last decade and maybe more, for Japanese investors, Japanese banks to buy US treasuries or other dollar bonds with high interest rates and hedge the currency risk back into yen. And that was a trade which worked perfectly for them. And of course, you can imagine there were hedge funds out there who did that in a leveraged way as well. And so the bank in Japan who was doing the trade could even, and probably did in many cases, borrow yen at the then interest rate of minus 0.1%. Obviously, you and I can't borrow it. That couldn't have borrowed at minus 0.1%, but a bank could have done and did, in fact, able to do that because that was the official rate where you could borrow from the Central Bank of Japan. So if you were a bank, you could borrow funds from the Bank of Japan at minus 0.1. In other words, they paid you to borrow the money. So banks were only too happy to take that free money, invested in US treasuries, had the currency risk, and they had no risk, and they're making a ton of money. But that's all gone wrong. And the reason it's gone wrong is that the cost of currency hedging has risen dramatically. Why has it risen? Well, short-term US rates are now 5.4%. And short-term Japanese rates have moved from minus 0.1 to plus 0.1. So the cost of hedging to a Japanese bank is 5.3% per year. But how much is the Japanese bank now earning on a US Treasury bond? They are only earning 4.25%. So it's costing them 5.3% to carry out the hedging, but they're only earning let's call it 4.3%. So they're losing 1% outright on that by continuing to as long as they continue to hold the bond, they're losing 1% a year. And nobody in their right mind wants to continue losing money hand over fist forever and ever. What's worse is the yield on the 10-year JGB, the Japanese government bond, has gone up from 0% now to roughly 1%. So the difference between what they're doing, which is losing 1%, and what they could be doing, which is investing in Japanese government bonds and earning 1%, is 2%. So those banks who've got large holdings of treasuries for historical reasons, because they're doing the carry trade, are now losing money hand over fist, and they would be 2% better off if they sold their treasuries, unwound the hedge, and brought the money back to yen and put it into Japanese government bonds. And we've had the first bank in Japan announced they're going to do it last week. And that was Norin Chukin Bank, who said I think they've got about 80 billion of foreign bonds when I looked at their balance sheet. And their announcement said, and I don't think it was an announcement, I think it was a comment. So it may have been an accidental comment, but what they said was, we're going to sell 63 billion of foreign bonds because we're not making any money on it. Now, that's one of countless banks in Japan. I just took four banks whose names I could think of, one of being the Mnt&x Bank. By the way, I'd never heard of that bank before. They made the announcement. But I took Mnt&x Bank and three others whose names I forget now, and added up how many foreign bonds they had. And collectively, those four banks had $500 billion of US dollar. Well, they didn't say US dollar. They classify them as foreign bonds, which I assume are mostly going to be US treasuries, but it could be European bonds and so forth. Of course, there's many other banks in Japan who might well be in the same type of situation as Mnt&x, i.e., their hedge isn't working anymore. It would be far more profitable to have Japanese bonds than it would be to have American bonds. So I think over the next year and a half, those banks will be unwinding their positions. You can't unwind that sort of size of position of one. I mean, I know the US Treasury market is extremely deep and you can trade in immense size. The daily volume is something like 20 billion, even maybe 30 billion maybe a day. But a lot of that will be rollovers of maturing debt and people going backwards and forwards 2 or 3 times a day. So probably if you started to try and dump billions a day, it would crash the market.
Clive,
so they're going to have to spread out.
Is that unwinding a pressure on the Fed to begin lowering rates?
I think the Fed is well aware of what might happen with Japanese banks. And if the Fed does lower short-term rates, it will become more attractive to keep those treasury positions. I don't know how important that is to the Federal Reserve, though, because they're supposed to be independent of the Treasury. I mean, let's look at it this way: the Treasury wants, that's the government, wants the Federal Reserve to lower rates, and the Federal Reserve wants to fulfill its mandate of trying to keep inflation in check. And the historical way of doing that, the way they believe they should do that, is by keeping rates high to try and slow the economy, or if you lower the rates, the economy overheats and inflation goes up. That's the traditional thinking.
So let me ask you this question. What are your personal inflation expectations and why? Are you seeing inflation as being whipped by the Fed, or do you see it as being more entrenched like the 70s and the 40s?
I don't think inflation is out of the system. I mean, first of all, I think we're looking at the wrong thing if we're looking at retail prices. We mustn't forget that just about everything you buy is to some extent, and in many cases to a large extent, made by robots. So there is a human element in there. That's the inflationary bit, but there's less and less of these variable, these rare. The rare commodity is the human labor. And in whatever you buy, there's less and less of that rare commodity. So more and more of what you're buying is just the cost of electricity, really, and transportation. And of course, behind that, you've got the marketing and so forth. But costs across the board are going down, except for human labor. So that's so. If we look at inflation, to some extent, it's telling us. Well, it is not to some extent. It's telling us the price of the things you buy in the shops, but it's not telling you how fast backwards you're going compared with everybody else who's got assets. So, as if I'm going to try and illustrate this another way, as the Treasury borrows money, it spends that money. So the Treasury goes deeper and deeper into debt. The Treasury gets poorer and poorer, or the government gets poorer and poorer, owes more and more. So as it owes more, because it spent the money, someone out there got that money. Someone got richer. Obviously, it's not every man in the street, but there's people at the top of the pile to whom the money will gravitate. The man, the inventor of iPhones, or the guy who's invented some artificial intelligence program. It will gravitate to the wealthiest at the top of the pile, the politicians and all kinds of people, not necessarily the man in the street who lives hand to mouth. But out there are more wealthy people, and as their wealth increases, because the government's getting poorer, they can afford to buy more things, but they're not going to buy more pizzas or more beer or go on any more holidays. But what they will do is spend more money on rarer items, and that would include works of art. It would include properties which are desirable. It would include gold, of course, and Bitcoin, and of course the stock market itself. Unless the stock market goes into a massive new issuance phase with new companies popping up like mushrooms in the night, we have a limit to some extent. We have a fairly static supply of shares in the stock market, which don't increase that much from one year to the next. I know there are periods like 1999 when the number of companies coming into the market were sort of 10 a day, and eventually the supply of new paper exceeded the increase in the wealth. But at the moment we don't have that going on to quite that extent, and so that's one of the reasons why the stock market itself is getting squeezed by up higher and higher, because there's more people with money on the planet, and they've got to deploy it in some way. So yes, if you are going to get poorer because the government debt is rising by about 13% a year. So I would say that's the true inflation rate for somebody who's got some savings. And if you've got your savings in a time deposit or a bond and you're earning 4 or 5%, even before taxes, you're going backwards.
Yeah. Wow. All right, so let's shift over to another topic. You did touch on this in your opener there, Clive. U.S. unemployment data, it's been weakening, not dramatically, but a little bit. And over the last 18 months, it's also been revised down more times than I believe it's been accurate. Recently, a Bloomberg economics writer published a piece, and she stated that the U.S. has overstated jobs by as much as 775,000 jobs. Then after she put that piece out, the JOLTS report came out showing job openings are cratering. What is all of the jobs data saying to you, and are you expecting an unemployment bounce higher over the next, 1, 2, 3 years?
Month after month, we see the new jobs number come out, which has been consistently a very good number. And sometimes it's only been a good number because the previous month number was revised downwards. Right. So people focus on the latest number and ignore the fact that the last number was perhaps to some extent made up. Because the more you take the previous number down, the more the current number looks good. So you might have two jobs reports where the number is, let's say 165 million people working exactly, but now they revised the previous number down by 1 million to 164 million. It looks like there's a million new jobs. Right. So one of the things I always look at when the jobs number comes out, the non-farm payrolls number, which is what everyone focuses on, is what's called the household survey. Mm-hmm. The household survey measures the number of people who are working, whereas the non-farm payrolls measures the number of jobs. These two numbers are going in opposite directions. The number of jobs apparently is rising, according to the non-farm payrolls, whereas the number of people working, according to the household survey, is going backwards. So what can we conclude? We can conclude that more and more people are giving up and saying, I can't get a job, it's pointless, I'm not even going to try anymore. Whilst at the same time, those who are hanging on for dear life to try and keep their head above the water are saying, my God, I've got to take a second or a third job to keep my head above water. So we've got a shrinking number of people who are taking more than one job and a growing number of people who don't have a job at all. So that's what these two numbers are telling me. Now, obviously, the number they're focusing on is the non-farm payrolls number, which is looking good. There's lots of jobs, apparently. But, from another point of view, there's lots of people who can't get a job.
So how sustainable is what you just described?
Well, eventually it will turn around, because you can't have more and more people squeezing and doing more and more jobs and more people not doing any job at all. I mean, one of the consequences of this is that we will have a growing number of people who are not contributing anything to the economy, and therefore they're a drain on Social Security, which is something which is it's a third of the U.S. budget. It's a third of what they spend. Now, I wouldn't for a minute say that they should cut back on Social Security. It's your legal entitlement, but the trouble is where can, if they have to cut spending, where can they cut? The other third is Medicare. They can't cut that. They'll be rioting on the streets if they cut that. The remaining one third is half military and half discretionary. They're not going to give up on the military, and there's discretionary. If you cut it to zero, it's not going to make much of a difference to the direction of travel of growing budget deficits.
And like you talked about earlier, you have the rising servicing costs, the debt servicing costs that is eating away at, well, there was no surplus. So it's eating away at any of those areas at the same time.
So if they can't cut costs, what do they do? Well, the other side of the equation is revenues. They could raise taxes, and in a way, there's a lot more room to raise taxes in the United States than there is in Europe, where taxes are so high that almost the pips are squeaking. So American taxes are a lot lower than the rest of Europe anyway. So they certainly could raise taxes, but then you're asking the turkeys to vote for Christmas.
Well, one of the things that, I've heard some other folks say is as long as they keep inflation up, and a lot of that money will find its way into assets, into markets, and with the baby boomer generation having forced withdrawals out of their 401k plan, as long as the market stays elevated, tax revenues are going to come in higher.
That certainly would work, because you're going to get a lot of capital gains tax if the markets keep rising, and there's got to be a lot of interest from all interested parties, whether it be congressmen or at the Federal Reserve or anybody for that matter, that the capital gains, the profits from investing your money keep rising. So how do you keep that going, that gravy train going? Well, you keep borrowing and spending money, which is what they're doing.
And that seems to be the most palatable pathway, so to speak. Out of all the ones that are possible, that seems to be the most palatable. Let everybody think that they're getting wealthier, and we'll just take more of that, and we're good to go.
And that's fine, as long as the whole world, Africa, Asia, UK, Europe, continues to be quite happy to hang on to these dollars and say, I don't mind being devalued by 10 or 12% a year. But what happens if that 10 or 12% a year turns into 15 or 20% a year? We start to say, you know what, this is turning into banana republic money and I don't want it anymore. We start to not want it.
Well, with the de-dollarization effort that's underway with the BRICS and the project Enbridge for their payment system and gateway that they're putting together, how realistic is it, outside of pulling away some of the dollars on the margins that is happening now, how realistic is it that a major pull away is going to happen amongst some or many of those countries?
Well, BRICS, Enbridge and all that, it's not going to change a lot in the short term. It's like turning a giant tanker around. It's going to take a long time for things to change. But change they will very gradually. I think the bigger danger for the dollar is that there's a sudden unexpected loss of confidence, which might be triggered by an unforeseen event, perhaps a political crisis. Obviously, we've got two very old men vying for president at the moment. We've got a lot of unfortunate noises being made about how America should involve itself in other people's political affairs around the world. And of course, we might have some natural disaster, maybe a California earthquake, or maybe we might get some political, civil unrest related to politics or something else. And it's not just America. It could happen. All of these things would happen anywhere on the planet. It might be a crisis in the bond market somewhere, the Japanese yen or the pound sterling, or who knows. It might be a power outage driven by terrorism or whatever. So there could be some trigger event that would be called a black swan that nobody really saw coming, which will cause things to turn out differently, but change very, very quickly. And that might turn into a bond crisis, a currency crisis, and that might precipitate some very rapid action by a government somewhere, which might or might not be the right action. But what will happen if that happens? Every other country is going to say, my God, look what just happened to, then they'll name their country, Canada or the UK or wherever it is. We might be next.
Well, I'll tell you what.
Panic starts.
So the black swan concept, I mean, they seem to happen once every decade, right? And we're working on almost a half a decade now since the pandemic. So, you know, something's probably going to be coming soon, something unforeseen. And with the debt situation and the debt servicing as it is, and all the geopolitical tension as it is, and all the, political tension inside the United States as it is, I can see what you're describing as happening as very high risk at this point. Let's focus on the geopolitical side for a moment here. Russian President Putin has recently shared conditions for peace, but then the West quickly dismissed it. The U.S. Congress has passed a new law making it easier to conscript American young men and women to military service. President Biden said it was okay for Ukraine to use U.S. manufactured weapons at targets inside of Russia. Putin told the world they aren't afraid to use their nuclear arsenal under certain conditions, and then also move nuclear subs and warships 90 miles off the coast of the U.S. Over the weekend, a drone strike in the middle of Russia is now being blamed directly on the U.S. by the Russian defense secretary. Clive, war drums are clearly ratcheting up, not down. In your estimation, where is all of this going? How concerned are you? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Clive as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.